What if rising interest rates were your secret weapon in property investing, not your enemy? Most panic when rates climb, but smart investors see opportunity. Higher rates cool the market, reduce competition, and open doors for those prepared. The pros use these shifts to negotiate better deals and secure properties with strong fundamentals. When rates fall, they don't blindly join the frenzy. They stay strategic, avoiding overpriced assets. Today, we'll reveal the real hacks, how to profit from both rising and falling rates, and why mastering this is your edge. Get ready to flip the script on interest rates and start winning in any market. Gen Z and millennials, you're entering a wild market, volatile, unpredictable, and full of noise. Forget outdated advice. Today's property game is different. We'll show you how to use interest rate changes to your advantage, not just survive them. Learn to spot undervalued assets during rate hikes and maximize rental yields when others panic. Avoid the traps of overpaying in a low-rate frenzy. You'll leave with a playbook for profit in any market. No more guessing, just clear, actionable steps. We'll break down real-world examples and case studies so you can apply these strategies right away. Ready to turn interest rates into your investment superpower? Let's dive in. Let's keep it simple. Interest rates are the price you pay to borrow money. They're everywhere. Mortgages, credit cards, even savings accounts. For property investors, borrowing rates are key. They determine your loan costs and impact your returns. Lenders charge interest to cover risk and the time value of money. Mastering how interest rates work is step one to smart investing. Understand this, and you're ready for the real hacks. Who sets interest rates? Central banks, like the Federal Reserve, pull the strings. They set a benchmark rate that influences all borrowing costs. Their main goals: control inflation and stimulate growth. If prices rise too fast, they hike rates. If the economy slows, they cut them. Every move is based on deep analysis of economic data. These decisions ripple through the economy, affecting your investments and job security. Understanding their playbook gives you a major edge as an investor. Okay, so central banks set a benchmark. How does that hit you? The most direct impact is on borrowing costs. When the central bank raises its rate, banks usually pass that on quickly. So, your new mortgage will be more expensive. That variable rate loan you have, payments go up. Business loans cost more, slowing expansion. Conversely, if rates are cut, borrowing becomes cheaper. Great for new loans. This is the most obvious immediate ripple. It directly affects your wallet and big purchase decisions, but the impact goes way beyond just your loan payments. Think about property prices. This is huge for investors. When interest rates go up, borrowing is pricier. This can cool down buyer demand significantly. Fewer people can afford to buy homes. This can lead to slower price growth, or even price drops in some markets. Lower rates? The opposite often happens. Cheaper mortgages fuel a buying frenzy. More demand chasing limited supply? Prices can skyrocket. This creates both opportunities and risks. Then there's the critical issue of affordability. It's not just about the sticker price of a house. It's about whether people can afford the monthly payments. Interest rates are a massive factor here. Even if house prices stay flat, higher rates, they can push homeownership out of reach for many. This directly impacts the number of buyers in the market, and it shifts people towards renting, which, as we'll see, can be an opportunity for investors. Affordability is a key metric driven by rates. It shapes the entire housing market landscape, and the ripples don't stop at housing. Oh no, interest rate changes affect the entire economy. Higher rates can slow down business investment. Companies might delay projects or hiring. Consumer spending can also take a hit. People tighten their belts when borrowing is expensive. This can lead to slower overall economic growth. Lower rates can boost business confidence, encourage spending, potentially creating jobs. As an investor, understanding this big picture is vital. It helps you anticipate market shifts and strategize. Interest rates are rising and the headlines are all doom and gloom. But what if this panic is actually your golden ticket? When others step back, savvy investors see opportunity. Less competition means more breathing room and better deals. So, don't panic, get prepared. Opportunity is knocking for those ready to listen. When mortgage rates rise, homeownership becomes harder for many, pushing more people to rent. This surging demand means landlords can command higher rents, boosting rental yields and cash flow. For property investors, this is a strategic advantage, turning rising rates into a powerful opportunity in the rental market. Rising interest rates mean fewer buyers, and that gives you, the prepared investor, more negotiation power. Sellers feel the pressure, becoming more flexible on price, closing costs, and repairs. Look for motivated sellers, those needing to move or offload properties. This is your chance to secure deals below market value, build instant equity, and create value as a smart investor. Okay, so rising rates aren't just sunshine and roses, creating buyer cooldowns. There's a flip side, a real challenge. The most immediate hit, your wallet takes a punch. Higher interest rates mean your mortgage repayments go up. Period. If you're on a variable rate, you'll feel this almost instantly. Even if you're looking to buy new, that loan is going to cost you more each month. This squeezes your personal budget. It can turn a comfortable investment into a monthly financial drain if you're not careful. This is the first hurdle many investors stumble over, often unexpectedly. It's crucial to acknowledge this basic reality. Then comes the dreaded negative cash flow monster. This is a big one for property investors. What does it mean? It means your property is costing you more money to hold each month than it's bringing in from rent. Ouch! Rising interest rates are a prime culprit here. Your loan repayments climb, but your rental income might not catch up as quickly. Suddenly, an investment that was putting money in your pocket is now sucking it out. This can be a serious strain, especially if you have multiple properties. It's a situation that can quickly deplete your savings and add massive stress to your financial life. Ignoring this possibility is a rookie mistake. Next up, refinancing challenges. This is a sneaky one. Let's say you have a fixed-rate mortgage that's due to end. Or maybe you want to pull out some equity. When interest rates are high, refinancing can become a nightmare. The new rates offered might be significantly worse than what you had. You might not even qualify for the same loan amount. This can trap you with an uncomfortably high interest rate on your existing loan, or it could scupper your plans to expand your portfolio. The easy refinancing options you saw during low-rate periods, they can vanish pretty quickly, leaving you with fewer choices and less financial flexibility. Finally, all these factors, higher payments, potential negative cash flow, refinancing difficulties, create immense pressure. This isn't just about numbers, it's about your peace of mind. Financial stress can lead to poor decision-making. You might panic and sell a good property at the wrong time, or you might cut corners on maintenance, hurting your investment's long-term value. Understanding these risks upfront isn't about scaring you off, it's about preparing you. Because smart investors don't just hope for the best, they prepare for the worst, and then strategize to overcome it. This awareness is your first line of defense. To face financial risks, you need a fortress. Smart investors prepare in advance, building resilience into their plans. Lock in manageable rates, stress test your strategy, and keep a cash buffer for emergencies. This is your ultimate safety net, protecting your investments no matter the storm. Now, defending your finances is crucial, but smart investors also know how to play offense, even when rates are rising. It's not just about hunkering down and surviving. It's about finding those clever ways to turn a challenging environment into one of calculated advantage. This means shifting your mindset from pure risk avoidance to strategic risk management, combined with an eye for unique opportunities that others might miss because they're too busy panicking. This is where you can really set yourself apart and continue to build wealth, regardless of the broader economic headlines painting a picture of doom and gloom. One of the most powerful offensive strategies during any market cycle, but especially during uncertain times, is diversification. Don't put all your investment eggs in one single basket. If you're focused on property, this could mean diversifying by property type. Perhaps a mix of residential and commercial, or single-family homes and multi-unit dwellings. It could also mean diversifying geographically, investing in different suburbs or even different cities with varying economic drivers. This spreads your risk. If one area or property type underperforms due to local factors or specific rate impacts, your other investments can help stabilize your overall portfolio returns, providing a much-needed buffer. Another key smart move is to actively hunt for high-yield properties. Remember how rising rates can push up rental demand? This is your cue. Focus your acquisition strategy on properties in areas where rental income is strong and likely to remain robust or even grow. A higher rental yield can significantly help offset the increased cost of borrowing. Do your research meticulously. Look for neighborhoods with strong employment, good schools, and desirable amenities, factors that consistently attract tenants. A property that generates strong positive cash flow even with higher interest rates is a true gem and a cornerstone of a resilient investment portfolio. Finally, it all comes down to maintaining a winning mindset, grounded in a long-term vision. Don't let short-term interest rate panic derail your well-thought-out investment plan. Stay informed, yes, but also stay disciplined. Focus on the fundamentals. Buying good quality assets in good locations at prices that make sense for your strategy. Be prepared to adapt your tactics as market conditions evolve. The investors who succeed through rate hike cycles are those who are resilient, resourceful, and always learning. They understand that risks are part of the game, but with smart moves, those risks can be managed, and opportunities can always be found. The central bank slashes interest rates. Suddenly, borrowing is cheaper and excitement fills the air. Mortgages look more affordable and buyers rush into the property market. Demand explodes, prices shoot up, and sellers celebrate. But for Gen Z and millennial investors, is this boom all upside, or are there hidden risks? When money is cheap and demand soars, markets can overheat. Prices rise far beyond fundamentals, fueled by easy credit and FOMO. Like a balloon stretched thin, the market becomes fragile. Buyers panic, rushing to buy before being priced out. Bidding wars erupt, and people overpay. But what goes up too fast can come down just as quickly. If the bubble bursts, many are left with negative equity and heavy debt. Extreme caution is your best friend in overheated markets. When interest rates drop and property prices soar, investors face a rental yield squeeze. If you overpay for a property but rents don't keep up, your yield shrinks and cash flow can turn negative, even with a cheap loan. Don't get swept up in the frenzy. Stick to your fundamentals, run the numbers, and be ready to walk away from overpriced deals. Sometimes, patience is your best investment strategy. Smart investors don't panic or chase headlines. They follow a clear plan, built on long-term goals and solid principles, not emotion. When rates rise or fall, they calmly adjust, never reacting impulsively. Their blueprint is long-term, focused on sustainable wealth, not quick wins. Adaptability is key. They shift strategies as markets change. And they're always learning, making informed, rational decisions, never following the herd. When interest rates rise and headlines scream crisis, smart investors don't panic. Instead, they see opportunity, using discipline and strategy to find value others overlook. They focus on fundamentals, searching for quality assets and strong cash flow, even as others rush to sell. Creative deals and risk management set them apart, turning market fear into opportunity. This is intelligent opportunism, building wealth when others hesitate. When interest rates drop, markets can go wild and property prices soar. But the smartest investors don't rush in blindly. They stay calm, stick to their plan, and focus on fundamentals. They may refinance existing loans, unlock equity, or strengthen their financial buffers, always with caution. Instead of chasing the frenzy, they stress test every deal and never let FOMO dictate their moves. That's how you thrive, by adapting, managing risk, and always seeking long-term, sustainable growth. We've demystified interest rates, turning confusion into clarity. They're not a financial boogeyman, but powerful tools for smart investors. Rising rates filter out casual buyers, creating opportunities for those prepared. Falling rates? Great for growth, but beware of bubbles and FOMO. Your personal investment plan is your North Star, adaptable, strategic, and key to lasting wealth. Master the swings, and you'll build wealth, one smart decision at a time. Gen Z and millennial investors, you're building your financial future, brick by brick. Don't let old narratives about interest rates hold you back. The knowledge and strategies you've learned are powerful tools. Use them to navigate any market. There's no such thing as a bad interest rate for a prepared investor, only new opportunities. Start applying these insights, build your plan, and take action. Your financial future is yours to design. Invest smarter, not harder.